Hello, welcome to this month's video from Flying Colours. As it's January, I think it would be quite useful just to look forward to the whole of 2023 and what we think that has in store for investors and what it means for our clients and our portfolios. If we look back to last year, we actually had what I would consider as a fund manager to be a very good year last year. We outperformed our peers, other fund managers, by a lot in every portfolio, somewhere between 2.5% and 5.5% to 6% across the range, which is a significant amount of outperformance during the year that we had, but we did lose money in every portfolio. So we did better than the average fund manager, but we still lost something close to 10% in most portfolios last year. So as a client, you may not be feeling quite as positive about our performance as we do. The reason we care about relative performance is because it sets us up in the long term to do very well. As I'm going to talk about later in the video, we think the portfolio is set up to do very well in the next 10 years. And the fact that we're outperforming now means we start from a higher base. And not only are we protecting the downside better, I actually think the assets that we own for you will do very well looking forward. So overall, I would say that 2022 is a good year, but as I'm going to cover in a second, I do think 2023 will benefit from quite a lot of the same trends and we don't need to change much. So as a reminder, our positioning has been to be underweight US equities and overweight international equities, including the UK. And very similarly, to be overweight or underweight growth shares, US tech shares, and overweight traditional lower priced value shares. Now, those two things have worked very well for us in the last year, but the trend of outperformance for US tech versus the other areas was a 10-year trend. And actually, we think the reversal will be a multi-year trend as well. So we've had one very good year using that approach, but it's too early to stop the positioning in our view, so we will continue with that. In the same way, in the bond market, we last year took the opportunity to quite significantly increase risk after yields rose, on the basis that the yields had risen to the point where they couldn't really go much higher because the economies couldn't stand it. So that we now get reasonable yields in our government bonds and especially in corporate bonds, and that's positioned those assets, of course, to do very well over the next year or two. Few years, and I don't see any reason why that will change either. So both in the equity and the bond portfolios, we now have assets that are both going to produce a good return, we think, and are likely to outperform other managers and the market. So we're all aware that inflation's been a big issue politically, economically. It's really affected everything in the last year, and it's been a big change. But right now, there is a really big debate happening within the markets about what the future direction of inflation is, and what the ultimate result is going to have a big impact on bonds and equities, and therefore on our portfolios. So inflation went to quite a high peak, and then it has now started to fall in most countries, and it's pretty clear that that peak is declining and inflation is about to come down quite significantly from perhaps high single digits, 10%, down to low single digits. Now, many people are thinking that this means that the problem with inflation is now a thing of the past and we can get back to what people would consider something to be as normal. However, if you look back in history at previous bouts of inflation, it always has been that there is a peak of inflation, a decline, and then another peak. Now, people make the argument that this time the situation is different, but we think that people are being too clever when they make that argument, and they're misunderstanding the nature of inflation. So inflation, like all things in economics, is a combination of a situation that's happening in the world and people's reaction to that situation. And it's the reaction of people that creates inflation. Now, the nature of people is timeless in our view. And so the fact that inflation has followed these patterns in the past makes us think it's likely to do that now. Now, our view that inflation will fall and then come back again is strengthened by our outlook for commodities. So we have a 5% position within our equity portfolios, specifically in commodities, and we have quite a lot of holdings in companies that benefit from commodities in our general portfolio. So we are quite exposed to it. The reason for that is we think commodities are very short, and actually that shortage is likely to really come to the fore this year. We've seen in the oil market, China has just reopened and the aviation market still hasn't returned to its historic level. So when those two things happen in the coming months, we're likely to move into a significant shortage in the oil market. And this is going to be repeated in many commodities. And when commodities move into shortage, the price moves up to a level where it starts destroying demand, and that price is quite a lot higher than it is today. If you think what destroying demand for a commodity looks like, it looks like pain and it looks like inflation. So we think inflation is going to come back, and we think it's going to come back partly for psychological, societal reasons, human beings, and partly because of a structural issue in the commodities market. So we are positioned for that in our portfolios, and we have significant inflation protection in the equity side and the bond side. And again, we think that this is going to serve us well in the next year. As I mentioned earlier, we have a lot of confidence about the portfolio and the outlook for the next 10 years. And we also feel really confident about our positioning for this year. We really expect that we'll outperform again. But I think from a client standpoint, or the people listening to this, the most important thing is how well will we do over the next 10 years. I think that is what's the key factor in people meeting their objectives for pension income or growth. We are invested in the equity side of the portfolio, overwhelmingly in shares which trade at an attractive valuation relative to their own history. In our view, this is the most important starting point for good long-term returns. So not only do they have quite low valuations in an absolute sense, they're also quite low compared to how they've traded themselves over the past. And if we look back in history, at times like this when people have invested, they've tended to do very well. So we might have a difficult year in the equity market this year, again, but I think over the next 10 years, it's highly likely that the portfolio will make money. And in the bond portfolio, which is more than half of our assets actually across all of the portfolios, we took advantage of what we considered to be attractive yields as the price of bonds fell to increase risk. And actually, I don't think anything has changed there. We now have an asset that offers significant risk protection and good, attractive returns for that risk. And I think people who are invested in bonds can relax knowing that the asset should deliver what they would expect over the long term from here. As always today, I've been talking about investments, so you must remember that your capital is at risk. If you're interested in these videos and you want to subscribe to them, don't forget to click on the Flying Colours logo that appears here and you'll automatically be subscribed. And if you have any questions about anything that I've said, please don't hesitate to get in touch. Thank you.